Four, 5 p.m. I think it's got a niche. It's a defensible niche. It's a very difficult moat to get over once they've established. Because we know the Defense Department, once it gets agreement, CIA, once they get agreement, the company never switch. Because the data is so proprietary and they don't want, but that's the advantage. The problem is you're negotiating with one buyer, right? Which is, you got to go with whatever pricing they give you. You have no pricing power. Okay, folks. So you know the question I'm going to ask you, right? Have you picked a company? How many of you have picked a company to value already? Come on, half the class still hasn't. Time's going, folks. I want you to pick soon, okay? So I'll keep nagging you till you pick. It's session 5. Might not think of it in this, we're almost 20% through this class, right? 28 sessions. By next session, we'll be more than 20% through. So pick a company, okay? So today I want to start by building on what we talked about in terms of risk-free rates and perhaps talk a little bit about risk premiums. Now, let's say you're valuing a company, right? Let's say it's a Swiss company, and you could probably put Nestle as the name of the company if you want. It gets its revenues, 10% of its revenues in Switzerland, 30% in the EU, 40% in the US, and 20% from India. So it gets it from all over the world, different currencies. I give you risk-free rates in each of the currencies. And then I tell you that, then I ask you a very simple question. You're valuing Nestle. Which of these risk-free rates should you use in your evaluation? I'll go through the choices, and if that is the choice you'd pick, kind of hang in there, right? First is a simple average of these rates. How many of you would go with just a simple average? Nobody? Okay. How about a weighted average? Okay, I knew that I threw the word weighted in, you'd be tilted right away because it sounds like, if I take a weighted, let me do a different example. Let's suppose that I told you, again, we talked about the Celsius Fahrenheit example. Let's assume the Fahrenheit temperature in London is 30 degrees and I'm sorry, Celsius is 10 degrees and in New York, it's 50 degrees. Would averaging those two numbers give me anything of meaning? Weight them with what? How can they have any meaning, right? If I took pounds and kilograms, and there's no weighting that's going to give you a rational number. They're different metrics. Never, ever average risk-free rates. You got to pick one, right? So let's remove that from the choices, the first two. Now here come the choices. The Swiss franc rate, since it's the lowest. That sounds like a good thing to have, right? Low risk-free rates, low discount rates. The lowest of the rates, let's be risk-free. Didn't we say risk-free rate? No, with the euro, didn't we use that as our? Maybe it should be the highest of the rates just to be conservative. Or maybe it's none of the above. I'll give you a clue. It's none of the above, and I want you to tell me which one it is. What do you think I should use as my risk-free rate? Did you estimate the cash flows? I assume to value the company, you estimate the cash flows, right? If you estimate the cash flows, did you pick a currency to do it in? I'd assume that, you can do it in Swiss francs, you can do it in, you tell me the currency you estimated the cash flows in, the risk-free rate has to be in that currency. Can I value Nestle in Swiss francs? Yes, as long as I'm willing to convert all the cash flows into Swiss francs. Can I value it in US dollars? Absolutely. As long as I'm willing to convert all the cash flows US dollars. Can I value it in Brazilian reais? You're saying, but they have no revenues in Brazil. It doesn't matter. Currency is just a measurement metrics. I can value any company in any currency. The risk-free rate has to come from that currency choice. Today, we're going to talk about equity risk premiums, and I'm going to talk about the way in which people estimate equity risk premiums, consultants, bankers. This approach is rooted in how we've estimated equity risk premiums in the US. And what we've done in the US starting in the late 70s, and I'll talk about what triggered this process, was we've looked backwards. What does that mean? We look at what we'd have earned on stocks as opposed to something risk-free over the last 50 years, the last 75 years, the last 100 years, and we use that as our equity risk premium going forward. So here's my question. Let's assume you're estimating historical. So you're looking at past risk premiums, not because you care about the past, but because you want to use them as a predictor for the future. And I'm going to give you choices on how far back to go. And you tell me which of these choices I could go back just 1 year. After all, I want the most current numbers. If I use just last year, you know what the risk premium, do you know what stocks made last year? Anybody have a guess? The return on stocks last year was about 26%. The return on T-bonds was 3.88%. So the equity risk premium last year was 22.12%. Do you think you're going to be able to earn that 22.12%? I don't think so. You think you're never going to buy stocks again. 1 year is too short. Could I do 5, maybe 10? I mean, remember your statistics classes, when you do a historical average, what are you trained to put in brackets below that number to tell the world how uncertain you are about the number? You do an average. The standard error, not the standard deviation, but the standard error. What is the standard error? It takes the standard deviation and divides by the square root of the number of observations you have. The more data you have, the more precise your average becomes. I've given you a pathway to how far back you want to go. If I go back over the last 10 years, my equity risk premium is about 7%. This is good, right? But you know what the standard error in that number is? About 5%. Now, if you remember your statistics, if I tell you the risk premium is 7 and I tell you the standard error is 5, I basically told you nothing, because the rule is plus or minus 2 standard errors. The true risk premium can be less than 0 or 17%. That doesn't help you very much. We're going to talk about why, when you use historical risk premiums, we're going to go back as far as we can. And part of you is going to scream, you're going back to 1928. That's going to be my starting point. Because 1928 was before the Great Depression. Was the US equity market very different then? Absolutely. Do I want to go back to 1928? No. But when you do historical risk premiums, you have no choice but to go back in time, because the standard error problem is so high. And when you do historical risk premiums, there is this internal contradiction you got to deal with. In 2022, we had a terrible year for stocks. Stocks were down 20%. It's bad, right? When I'm at the end of the terrible year and I bring that year into my historical returns, I bring a really bad year into stocks, what do I do to my average return over time? Bring it down or raise it up? I bring a really bad year into my data set. I'm going to lower my return over the period because I brought a really bad year. You're saying, so what? When I lower that number, I get a lower risk premium. Let me ask you a question. You're after a really bad year in stocks. Stocks are down 20%. Do you feel more risk or less risk investing in stocks after that year? I don't know about you, but I feel far more exposed to risk because I mean, I've gone through risk this entire year. And I'm telling you, that's okay. Use a lower risk premium. I said, that doesn't make any sense. I'm going to talk about why I think historical risk premiums are a particularly dangerous way to think about risk and what I would use as an alternative. No, but I'll, rather than talk about the alternative, which I'll come and talk about next class, let's focus in on the rest of the risk-free rates. I won't do the last page, which I'll do it at the start of the next. But we're going to talk about completing the discussion on risk-free rates and then talking about historical risk premiums. So if you remember yesterday, we were talking about getting a risk-free rate in a government where there's default risk. I use the example, I think, of the Indian government, right? 7.18% government bond rate. And if you remember, I cleaned up that government bond rate by taking out a default spread. I want to pause there and make sure everybody's comfortable with what I'm doing and why I'm doing it. I want to get a risk-free rate. The government bond rate is not risk-free. I'm removing the default risk to make it risk-free. But this 2.39% seemed to come out of nowhere, right? You're saying, where did that number come from? So I'm going to take you through 3 ways in which you can get that default spread because you will need it. Some of you are working with governments where there's default risk. You got to clean up for that default risk. I'll take you through those 3 approaches. The first is, if that government that you're trying to get a default spread for has issued bonds in dollars or euros, you got incredibly lucky. And here's why. The Brazilian government issues 10-year bonds denominated in dollars. How is having a 10-year dollar borrowing rate for the Brazilian government going to allow me to get a default spread for Brazil? What am I going to compare the 10-year rate to? The US 10-year T-bond rate. They're both in dollars. I can compare the dollars to dollars. This is Fahrenheit to Fahrenheit, Celsius to Celsius. That difference is a default spread. It's easy to get, but here's the catch. It's available for about 20 governments. Only 20 countries have government bonds in dollars or euros. For those governments, I can get a default spread by comparing that rate to a T-bond rate. Or if it's a euro bond, I think some East European countries issue bonds, I can get the default spread by comparing to the German euro bond rate. The Polish government, for instance, there's 10-year bonds in euros. I can compare to the German euro bond rate. That's the first. The second is there's an actual marketplace out there where you can get a market-based estimate of a default spread. I don't know whether any of you have heard of this market called the sovereign credit default swap market. You know what the CDS market is called? What exactly are you able to do in this market that you couldn't do until 20 years ago when the market first showed up? So let's say you buy a Brazilian government bond. What does a sovereign CDS bond or a sovereign CDS allow you to do with that bond? Yeah. It allows you to buy insurance against default risk. So here's the way it works. The Brazilian government has a 7% bond rate. You're worried about the Brazilian government defaulting for whatever reason. You go to the CDS market. They will sell you insurance, and here's how the insurance will be priced: 2.5%. You're saying, what does that mean? Every year when you collect 7% on your bond, I'm going to come take 2.5% away, saying that's your insurance premium. So if the Brazilian government never defaults, you're going to end up earning 4.5% or 7%, but you didn't have any sleepless nights wondering, will they default? The nice thing about the sovereign CDS market is it's set by market demand and supply. Why is that nice? Because anytime things change, the market price will change. The day Russia invaded Ukraine, the Russian CDS spread obviously reacted, the Ukrainian CDS spread obviously, but all the East European countries saw their sovereign CDS spreads go up because people were more worried about default across the board. So you've got government, if you have a government bond in dollars or euros, you can compare to the UST bond rate or the euro risk-free rate. If you have a sovereign CDS market, you can get the spread directly from there. There are sovereign CDS spreads now on about 80 countries. Better than the 20 that you got with the government bond, but you're still stuck at 80. There are 180 countries. You're saying, what do I do with the remaining countries? My third approach allows you to get a default spread for countries that don't have a sovereign CDS and don't have a government bond in dollars or euros. There are about 150, maybe 160 countries with sovereign ratings. We talked about Moody's and S&P rating countries. If you can tell me what the rating for your country is, I can estimate what the default spread should be for that country by looking at traded bonds with the same rating. So the Baa3 rating that you saw for India, there are a bunch of other governments with Baa3 ratings. Many have sovereign CDS spreads. And government bonds, I can look up what the typical default spread is. That's a 2.39% based on the rating. So let's take each of these and try them out to see how this works out. And I'm going to use Brazil as my example to illustrate how this process goes. Started 2014, you're trying to get a risk-free rate in Brazilian reais. You want a default spread for Brazil. First stop was, I found a Brazilian 10-year dollar bond, 5.75%. That's a traded bond. That's the yield to maturity or interest rate on the bond. 3.88% was the government bond rate in US dollars. Assuming the USD bond is a risk-free rate in dollars, that difference, 1.87%, becomes my estimate of the default spread for Brazil, the difference between those two. The only reason I'm able to do that is that both dollar-denominated bonds. Any questions on that? So that's the first. Second, I went to the CDS market. For those of you, and I'll send you an email later today about the Bloomberg terminals that you can access. You get on a Bloomberg and type in SOVR, and I'll send you the instructions as well. You will get these spreads for every country on which you can buy insurance. You can get a 10-year spread. So if you look across, there's Brazil. The sovereign CDS spread on December 31st of 2023 was 2.39%. Basically, that's what it'll cost you on an annual basis. That becomes a market's estimate of the default spread in the country. The one problem with the sovereign CDS market is that it remains counterparty risk. You know what counterparty risk is? You buy insurance. The insurance is only as good as the person promising you the insurance. In the sovereign CDS market, there is no guarantee that that'll be backed up. In fact, in 2008, when Lehman fell apart, one of the problems, this market almost broke up completely because Lehman was one of the biggest sellers of sovereign CDS spreads. And if you bought insurance from Lehman, God help you. What could they insure you against? They're going under. What that effectively means is what you see as a CDS spread might not be a full measure of the actual default spread for the country. So I do this makeshift adjustment, and you can do it or skip it if you want. I take the default spread for the US, which at the start of 2024 was actually much higher than the default spread in Scandinavia or parts of Europe. And I subtract it from the CDS spread for Brazil. And in effect, what I'm saying is, if these are truly default-free countries, which based on the rating they should be, that spread is for the friction in the market, the fact that it's not a pure insurance market. And I'm subtracting that 50.58% from 2.39%. Think of that as a risk-adjusted or cleaned up default spread. So at this stage, I have two measures of default spread for Brazil. One is 8.87%. The second is either the 2.39% or the 1.81%, depending on what you take out of the sovereign CDS market. The third approach, I look at Brazil's rating. And Brazil's rating at the start of 2024 was BA2. BA2 rated, and these are the typical default spreads based on your rating, is 3.28%. So I have 1.81%, 8.87%, 1.81%, 3.28%. Now, part of saying, which one should I use? Pick one, but stay consistent. You're going to see what I mean by stay consistent. Make a choice. You want to go with the government bond-based default spread, by all means do it. It'll give you a much higher risk-free rate, which is a bad thing. But later, when we talk about equity risk premiums by country, I want you to stick with that measure of the default spread. The advantage of the ratings-based spread is I can do it for 160 countries. I'm going to stick with that one simply because it gives me the widest arena of being able to apply this on pretty much every country. So three ways: government bond in dollars or euros. We can find that. You can get a default spread. Second, go to the sovereign CDS market or visit your local Bloomberg terminal. Look up the spread for your country. Third, look up the sovereign rating for your country. Look up the default spread that goes with that rating. And then pick one and keep moving. Keep moving is going to be the theme for this class. Don't get stuck. You will get stuck. You'll feel this urge to obsess over something that you're not quite sure about. My advice is you will never be sure about it, no matter how much you obsess about it. So keep moving. You can always come back. but these are the ways you can get default spreads for a country. Any questions? Now, earlier we talked about real risk-free rates, right? Real risk-free rates, you're basically not including inflation in your cash flows, and you want a risk-free rate that doesn't have inflation embedded in it. 20 years ago, we had to estimate real risk-free rates. The way we did it was we took the T-bond rate and we subtracted out what we thought expected inflation would be. And we said, that's a real risk-free rate. We don't have to do that anymore. If you remember, I gave you a choice of the inflation-protected T-bond. The inflation-protected T-bond rate in January 2024 was 1.80%. What does that tell you? If you bought the bond on January 1st, you were guaranteed a risk-free rate, a rate of return of 1.8% before inflation. That is what I would use as my risk-free rate if you're doing things in real terms. But here's the problem. Almost no one in the US does things in real terms. You know where you're going to see real valuation? Latin America, parts of Eastern Europe, parts of Asia, where you have inflation is high and volatile. So people get tired of dealing with inflation. They say, I'm going to remove inflation from my process by doing everything in real terms. I don't have a problem with that. But remember, this is as cosmetic. You've removed inflation from your numbers, you've removed inflation from your discount rate, but inflation is still very much part of the game. It's still going to affect you. But if you want to do things in real terms, you can have a real risk-free rate. Just use the TIPS rate. Implicitly, you are assuming that this is the real risk-free rate no matter where you go in the world, because capital can flow freely. If capital can flow freely, you shouldn't have different real risk-free rates in different parts of the world, because money will flow out of low-rate countries into high-rate countries. Already you can see the layers. When we started this process, the risk-free rate, that should be easy. But you can see already that there are layers here that you might have to delve through before you come up with a number. So now I'm going to show you a graph, and I'm going to ask you a question. If you can answer this question, you've cracked what I call the currency code. You're going to be okay with currencies. Start of 2024, I estimated the risk-free rate in about 40 different currencies. I'll tell you why I had to stop at 40. Why didn't I do them? There are 160 currencies, and why only 40? These are the 40 governments that actually had 10-year bonds in the local currency. That was my starting point. And then I subtracted out. The red portion of each is the default spread. So I'm doing for every country what I did for India and for Brazil, is taking the government bond rate and subtracting out the default spread. So the blue portion of this graph is the risk-free rates in different currencies. I'm going to start with an obvious statement. And then I'm going to ask you why the fact exists. The obvious statement is risk-free rates vary across currencies. They're high in the Turkish lira, Zambian kwacha. They're lower in the US dollar, and even lower in euros, and even lower in Japanese yen. Why do risk-free rates vary across currencies? Anybody want to give that a shot? I didn't ask why government bond rates vary, because then you can do this risk difference, risky government. No, let's assume I've cleaned up for it. These are risk-free rates. Why do risk-free rates vary across currencies? You want to try? Anybody want to try? You're good. No, remember I cleaned up for it. That's why I've taken the risk. But doesn't matter. All you care about is default, right? As long as the default risk is on, it should be risk-free. You're not worried about economic risk. This is not equity. This is fixed income. If I've removed the default risk and this is truly default-free, well, I mean, again, as a bondholder, what do I care about GDP growth, right? I mean, if you're an economist, you worry about this. As a bondholder, all I care about is, am I going to get paid? Am I going to get paid? Right? You're getting closer. What do central banks do? What's the only thing that central banks actually have an effect on? Inflation. That's it. You cleaned up for things. The reasons risk-free rates vary across currencies is because of differences in expected inflation. High inflation currencies will have high risk-free rates. Low inflation currencies will have low risk-free rates. Deflationary currencies can have what? Negative risk-free rates. And that's why currency doesn't matter in valuation. What did I say? When you value a company, you can value it in any currency, right? You can value a Brazilian company in reais, you can value it in dollars. When you decide to value a Brazilian company in reais, you're going to get a much higher discount rate. Absolutely, every single time. Why? Because the risk-free rate is much higher. You're saying that's bad, higher discount rate. But when I do my cash flows in reais, because those cash flows have to be in reais, that same high inflation that pushes up my discount rate will also push up my cash flows. What one hand gives you, the other hand will take away. What one hand takes away, the other hand will give you back. Otherwise, we'll all be valuing every company in Swiss francs because it makes our values higher. The reason that's not going to happen is the Swiss franc, the inflation is close to zero or even deflationary. You're going to have a low discount rate, but your growth rates will be lower and your cash flows will be lower, and you get an exactly offsetting effect. Yes? It's expectations, right? It's not the actual inflation from last year, it's expected inflation. And it's true, Argentina is on a cusp. We don't know how the cusp will play out. There's a lot of game left in here. You could argue that the way it'll show up is the Argentine government ever had the courage to issue a 10-year bond in pesos and people had the courage to buy that bond, the rate on that bond should come down when people's expectations of inflation come down. Okay? It'll also show up in exchange rates. Why the same difference in inflation that drive your interest rates will also drive expected exchange rates. So inflation is always in the background, or sometimes driving everything in this process, the sole driver of differences in risk-free rates across currencies. Yes. It comes from your head, right? That's a good question. How do people form expectations of inflation? Last year, why did people all of a sudden know? It's not like somebody fed them a number. They walked into the grocery store or you walked into the restaurant. I mean, you guys have had this experience the last couple of years. You walk in, I walked into the restaurant, I had a cutty roll at that cutty roll place. It cost me $2 more than it did 2 years ago. You're saying, that is so petty. That's how expectations get set. If you find yourself paying more than you did, and once your expectations get set, it changes your behavior. In what way? When you go ask for a wage increase as an employee, if you're noticing you're paying 7% more, you ask, inflation is, you see why it's so insidious, right? Once it gets started, it kind of eats its way. It takes a while for expectations to change, but once they change, it becomes very difficult to change them back. So differences in expected inflation drive it, and those expectations are driven partly by historical data. But when you have a country, when you have a shift in regime like you do in Argentina, people are hopeful. Maybe this will be different, right? But that's going to play out over time. And if it's not different, they're very quickly going to revert back saying nothing changed. So it'll be interesting to see how expectations change in Argentina, or if they do, because it is going to be a test of, how much this can actually shift. So that's what causes risk-free rates to be different across currencies. Can risk-free rates change across time? Absolutely. I was teaching this class in 2020. When we started the class, we were looking at, when you looked at the T-bond rate, it was low. It was 1.7, 1.7% low by historical standards. 3 months in, halfway through the class, the T-bond rate had dropped to 0.7%. The T-bill rate had gone to 0. Don't even ask me what happened. Come on, you were around in 2020. You know what happened. The world shut down. When the world shuts down, economic growth collapses, inflation goes, people expected deflation to come out of it because nobody has money to spend. That was the story. Can interest rates change over time? Absolutely. They decreased in 2020. And what did they do in 2022? They started the year at 1.5%. They went to almost 4%. It was the biggest single year move in T-bond rates in history. Interest rates can change. Why do they change? Because expectations of inflation change, expectations of real growth and real interest rates change. So what I'm saying is your valuation is due May 6th of 2028. I'm sorry, not 2028, 2024. Okay? So don't use it as an excuse. He gave us 5 years to do this. Then your grades will take 5 years to get delivered as well. But interest rates can change. Right now, the rates are pretty close to 4%, but I think they jumped about 15 basis points just today. Okay? So who knows what they will be on May 6th. If nothing else, keep that input because it's an Excel spreadsheet. Everything gets connected automatically. You don't have to update anything else. Adjust your risk-free rates as you go through time because, if you want, you can actually connect it directly to Yahoo Finance 10-year bond. If you have an Excel spreadsheet, you can take the cell, and if you don't know how, go on, YouTube, they'll show you how to do it. That way your valuation gets updated constantly as risk-free rates change. So that gave me risk-free rates in 40 currencies. And I'll be quite honest, in some of those currencies, I don't believe the risk-free rate. The Vietnamese dong, I don't think has a negative risk-free rate. And I'll tell you what I think is causing the problem. What did I start with? A government bond rate, right? Why do we trust the T-bond rate? Because it's not set by an entity. It's not set by the government. It's set by demand and supply. There are literally trillions of dollars at play in this, right? It's a liquid traded rate. So you might disagree with it, but it is what it is. I've never found anybody. I called around and said, have you ever bought the Vietnamese government bond? Nobody had ever done it. It turned out that there's a government bond rate, but it's set by the Vietnamese government, and Vietnamese banks are required to buy the bonds at that rate. It's not something you can do. And already I'm skeptical as to whether this is actually a market set rate. Come and say, you have to buy it at 4%. What are you going to do as a Vietnamese bank saying, I don't want to do it? So if you don't trust a government bond rate, and there are a few governments here where I don't trust the rate. For the longest time, the Venezuelan government claimed that their 10-year bond rate was only 11%. This was when inflation was 5,000%. I'd like to see that person who's buying a bond at 11% interest rate. I don't think that person exists. So if you don't trust the government, or the government doesn't have a long-term bond, there is a way you can still get a risk-free rate, and the pathway goes to that inflation argument that we've just used. I'll give you an example. A few years ago, I was valuing an Egyptian company. There's an Egyptian bank called CIB, and I wanted to value it in Egyptian pounds. If I want to value an Egyptian company in Egyptian pounds, I need a risk-free rate in Egyptian pounds. I went looking for a long-term Egyptian government bond rate in pounds. None. The Egyptian government borrows from the World Bank. It doesn't even issue bonds. But I really, really wanted to do it in Egyptian pounds. So here's what I did. I started with the T-bond rate. You're saying that's very parochial of you. That's fine. I'm going to have a starting point. And then I looked up two numbers. The expected inflation in Egypt, which at that time was 15%, and the expected inflation in US dollars. You know what? The expected inflation in US dollars is actually easily computed. You take the T-bond rate, you compare it to the TIPS rate. Right now, the T-bond rate is 3.88%, or at least at the start of the year. The TIPS rate was 1.8%. That difference is a measure of expected inflation. Expected inflation then was 1.5%. Now, if you're in a hurry, here's what you can do. Take the T-bond rate, add the extra inflation, which in this case is 13.5%. That will give you a risk-free rate in Egyptian pounds. I've done what you should do usually with risk-free rates as a compounding effect, which kind of moves the number a little bit. But as I said, if in a hurry, you just add the differential inflation, you can get a risk-free rate in any currency. So in this case, my risk-free rate in Egyptian pounds is 15.57%. So why is it so high? Because inflation is 15%. So if you have the T-bond rate or a Euro bond rate, and you want to get a risk-free rate in rubles, a risk-free rate in some currency where you cannot find a government bond, you can still get that risk-free rate if you're willing to get expected inflation numbers. The IMF, the International Monetary Fund, actually gives you expectations for the next 5 years. If you want to go to that website, it'll at least give you a sense of, I pulled it from somewhere, and just make it up. You can get a risk-free rate in any currency. Couple of final loose ends about risk-free rates. And on January 1st, 2022, again, I was teaching this class, the T-bond rate was at 1.5%. And the reaction that people had was, that number looks too low. In fact, we spent an entire decade where analysts looked at risk-free rates in the US and Europe and said, that number looks too low. And the minute you say that, you're going to be lost, because what's your next reaction? If it looks too low, let me replace with a number that's more reasonable. And here's what I heard from analysts. They said, I'm not going to use the T-bond rate right now. It's too low. I'm going to take the average T-bond rate over the last 30 years. You see where this is going, right? Because if that's the rate over the last, and that number was like 4.5%, maybe even 5%. It's called normalizing the risk-free rate. There are appraisal services that actually suggested to appraisers they should do this. And I thought it was horrifically bad practice. And maybe explain why. Let's say the T-bond rate is actually 1.5%. And you replace it with this normalized T-bond rate of 5%. Just go through the mechanics. What's that going to do to your discount rates? You replace 1.5 with 5% as your starting point. That's going to make your discount rates much higher. It's going to make your value much lower. You're going to tell me not to buy the stock. And what do I do with my money instead? Invest it at a normalized T-bond rate at 5%. Good luck with that. It exists only in your mind. The T-bond rate is not some, it is an opportunity cost. If you don't invest your money in stocks today, this is what you're going to invest in. And guess what? If it's at 1.5%, you got to take the 1.5%. Could it be 3% a year from now? Yes, but everything will change if it's 3%. Don't mess with risk-free rates. Don't look at the number and say, that looks really low. Let me replace it with something more normal. Leave risk-free rates alone. Right? Just be consistent when you do the rest of your analysis to bring in the message you're getting from low risk-free rates into your cash flows, into your growth. And there will be a message. And we'll talk about how to keep your valuations consistent. But risk-free rates should be left as is. One final point, and this deals with what I talked about at the start of last class about the Fed setting interest rates. I guarantee you that this talk will pick up again in the next few weeks, right? It's an obsession with CNBC. I think they have nothing to talk about. So this becomes, what will the Fed do? What will the Fed do? Okay. And the legend is that the Fed kept interest rates low for the last decade. So I'm going to push back on that by going back to what I just said about what sets interest rates, which is expected inflation and an expected real interest rate, right? It's called the Fisher equation. So here's what I've done in this graph. The black line is the T-bond rate. So you can see it went up in the 70s, and the last decade, it went down and it stayed low. On the same graph, I have two numbers that I pulled up each year. I pulled up the actual inflation rate, not even the expected number. So it's a kind of a simplistic measure. The actual inflation rate and the actual real GDP growth that year. So if your actual inflation rate is 2% and your real GDP growth is 1.5%, I add the 2 to the 1.5%. I come up with what I call an intrinsic risk-free rate, a risk-free rate based on fundamentals. I don't know what you think about it. You might have problems with it, but take a look at the two lines. One is the black line, the T-bond rate. The other is my intrinsic. Do you think the two move together? They seem to do a pretty good job, right? So let me ask you a question. Why were interest rates so high in the 1970s? Because inflation was high. And when inflation is high, interest rate goes so bad. Why were interest rates low in the last decade? Because inflation was low and GDP growth was anemic. What's low plus low? Low. Did the Fed have an effect on rates? Yes, at the margin. So what caused rates to go up in 2022? Don't tell me the Fed raised rates. The Fed wasn't even moving in 2022. Interest rates went up in 2022 because inflation came back. I think it's amazing how we've lost touch with that very basic understanding of interest rates. Because for 15 years, we've been told central banks set rates. And we're now too brainwashed to think for ourselves. Let me ask you a question. What will rates do this year? If you take the Fed route, what's the Fed say? No, at least the talk about what the Fed will do this year. What are people expecting the Fed to do? Cut rates or raise rates? Cut rates, I hear. At the end of the year, don't be surprised if rates are actually higher than they were at the start of the year. It'll really depend on what inflation does during the course of the year, not what the FOMC, the Fed does. So let go of this sense of the Fed sets rates. I'm going to care about what the Fed does. You have far bigger fish to fry. Focus on inflation, focus on real growth, because that's what's going to drive rates. And final point on risk-free rates is, as you saw on that graph, there are two currencies with negative risk-free rates. One was the Swiss franc. The other was the Vietnamese dong. So even if you throw the Vietnamese dong out, the Swiss franc still has negative. And 5 years, I'm saying, at the start of 2022, there were 5 currencies with negative risk-free rates. The Swiss franc, the euro, I think the Hungarian, or the Czech koruna. There were 5 currencies with risk-free rates. And the Japanese yen. Japanese yen stays there all the time. And every time risk-free rates go negative, people freak out. Why? Because we're not used to it, right? In econ class, when do you ever have negative interest rates? And they want to replace it again with a normalized number. And my suggestion to you is, don't. Even though it'll make your cost of capital lower, that negative risk-free rate is actually sending you a very bad signal about the future for your economy, right? What is it telling you about inflation in the future? Could be deflation, which means when you do growth in your nominal cash flows, you got to put in a no. And a negative risk-free rate also is an indication that people's expectations of real growth in the economy have gone to zero and below. Why do you think that happens? I'll give you the two parts of the world where you're seeing negative risk-free rates most frequently. One is Japan. The other is Western Europe. What do they share in common? Demographics, right? You've got, I think, Japan's an astonishingly high percent of the people are over the age of 65 and 70. You got an aging population, and I don't mean to be ageist, but an aging population goes with lower growth, negative growth. You know, you probably know I was going to start the class by asking you what's going on in China. Let you know if you have no idea what's going on in China, go look it up and look at what the Chinese equities have done this month. You're going to be flabbergasted. But China has a demographic bomb also waiting to go off, right? Which is the people's expectations are the population of China will shrink and age. There's a negative risk-free rate phenomena that might be coming down, and it's never good news. You get lower discount rates, but you don't want the rest of the stuff that comes with negative interest rates. Just be consistent. Okay? Don't try to fix things with risk-free rates. Any questions at all about risk-free rates? So if I asked you what the risk-free rate in the currency is, you should at least be able to go through the process of coming up with it, right? So let me try it. So if I ask you for a risk-free rate in Thai baht, tell me where you'd start. Okay, before you do that, you first have to find a government bond in Thai baht, right? Because if you don't, then that route gets cut off. So there is a 10-year Thai government bond. Then what's the next step? You have to come up with a default spread. You can find a dollar-denominated bond, which Thailand doesn't. You might be able to find a sovereign CDS. Thailand does have a sovereign CDS. Or you can look up the rating for Thailand and come up with a default spread. You can clean up the risk-free rate. You have a Thai baht risk-free rate. Okay. Try it out. Even if you're doing your valuation in US dollars and euros, you got lucky, right? You got a risk-free rate, right? Pick a currency where risk-free rates are not that straightforward and do this process because I want you to get comfortable getting a risk-free rate in any currency. So let's talk about the second big input in this class, which is the equity risk premium. I'll tell you what the equity risk premium is trying to measure, and you're going to very quickly see why it's so difficult to do. I don't know how many of you have money in equities. How many of you have money in equities? And what do you have money in? Individual stocks or funds? Okay. What do you have? Mix. Okay. Why do you invest in equities? To get a higher return. Then what? Higher than what? Higher usually has to go with some comparison. Then bonds, right? So you have a risk-free investment. Right now you can make 4% on bonds in dollar terms. Of course, currencies matter, but you're investing in equities because you want to make more than 4%. Is that fair? I mean, otherwise you'd be crazy. After the fact, could you make less than 4%? Yes, that's a risk in equities, but nobody should be dumb enough to invest in something risky saying, I'll settle for something less than what I could make risk-free. The equity risk premium is supposed to measure how much more than the risk-free rate you would need to make to invest in equities. You see already what that's going to be driven by, right? It's going to be driven by how risk-averse you are. It's going to be driven maybe even by how old you are. Older people tend to have higher risk premiums than younger people. And it could be driven by the time you live in. You come off a crisis, people get scared, the risk premiums can go up. But it's not an observable number. Because when you bought stocks, when you bought an index fund, I'd ask you, what's your expected return? Even though you had a number in your head. The equity risk premium is not observable. And we've struggled with how to estimate something that you cannot observe. So I told you about the trick that analysts in the US have done. I can't observe it. So here's what I'm going to do. I'm going to look backwards. It's called a historical risk premium. And at the start of every year, I actually update that number on my website. I update the historical equity risk premium for the US going back to 1928. Why do I start only in 1928? Because, you know, the equity markets before the 1920s, you had a tough time actually even getting enough stocks to get an index together. There are actually databases that go back to 1871 in the US. Very tough to trust them. So I started in 1928. So my longest time period is 1928 through 2023, through the end of 2023. That's 96 years of data, or 95 years of data. I also try 50 years and 10 years. And here's what I do. It's very simple. I compute the returns on average that I've made each year on stocks. Let's make up a number, 8.3%. And the return each year over that period that I've made on T-bonds, let's say 4%. Then I subtract the 4 from the 8.3. This isn't rocket science. And I say the historical risk premium. You think this is good. I get it. But I'm going to give you the catch. If you ask me what the historical risk premiums in the US, I can give you 12 different numbers, ranging from the low, I think is the lowest number I have is 4.97%. And the highest number on this page is 11.7%. How does that help you to tell you that your equity? You're saying, how can they be so different? Depends first on what slice of history I look at. 10 years, 50 years, almost 100 years. It depends on whether you use T-bills or T-bonds as my risk-free investment. T-bills are short-term, 3 months, 6 months. T-bonds are 10-year. It even depends on how I compute my average. What do you mean? Traditionally, how do you compute average? If I ask you for an average over 95 years, you take the returns every year for 95 years, you add them all up and divide by 95. That's a simple average. But there's a second, it's also called an arithmetic average, a simple average. But the second thing I can do is if I invested $1 in 1928, how much would it be worth in 2023? And compute what's called a compounded average. If you're wrestling with what's the difference, if I have a stock that starts at 50, I buy it at 50, it doubles over the next year to 100. What did I make in that year? 100%, right? The next year it falls back to 50. So if I look just at the second year, what was my return in year 2? 100 to 50 is minus 50%. So if you actually bought the stock at 50 and it ended up at 50, what return did you make over the 2 years? Nothing. Through the magic of arithmetic averaging, I'm going to convince you made a 25% return a year. You see why? If I take the 100 minus 50, you get 50, you divide by 2. Mutual funds used to play this trick prior to 1974 when the SEC changed the rules. A geometric average reflects what you actually make and give me good. So depending on the choices I make, I get very different risk premiums. But before you trust any of these numbers, let me tell you what I think. I think these are all crappy numbers statistically. And here's how I'm going to back it up. Remember we talked about standard errors? See these italicized numbers? Those are my standard errors if I go with that period of history. So if I go back all the way to 1928 and tell you that the equity risk premium is 5.23%, second decimal point, the standard error in that estimate is 2.14%, which means the true equity risk premium can be anywhere from 1 to 9, plus or minus 2 standard errors. That's with 95 years. If I go 10 years, I can give you a risk premium, but the standard error is so large, I'm going to give you a range that's immense. Historical risk premiums are extremely noisy because stock returns are so incredibly noisy. It's estimated you need 250 years of uninterrupted history in a market that doesn't change before you can trust a historical risk premium. Good luck with that. So historical risk premiums are noisy. The standard error you can, and the longer the period of history you have, the smaller the standard error becomes. But even with 100 years of data, you can see the standard error is huge. And second, which market did I pick to compute this historical risk premium in? The US equity market, because the only market with that period of history. You know what the most successful market of the 20th century was? In terms of adding market cap, it wasn't even close. It was the US equity market. You've heard of survivorship bias? In survivorship bias, what you do is you pick a winner and then you work backwards. I figured it all out. Dow 30 stocks, they've all done well. Of course they've done well. How do you think they got into the Dow 30 to begin with? Do you see the survivor bias issue here? I've taken the most successful equity market of the 20th century. I worked backwards and said, you'd have made a nice hefty premium in this market. But the problem is today, what is it that you know? You don't know what the most successful market will be for the next 70 years. It's a survivorship bias. So historical risk premiums are not just noisy, but they reflect at least in the data we use, often the most successful market in the world, the US equity market. But in the US, at least you can debate, do I go back 100 years? Do I go back 50 years? Do I go back 10 years? No. About 3 years ago, I got an email from a Vietnamese equity research analyst. So there's actually a budding equity research business in Vietnam. And he said, look, I'm valuing a company in Vietnam. I've never done valuation before. I'm doing this based on your lectures and your notes. And I want you to take a look at my Excel spreadsheet and tell me whether I'm on the right track. And he specifically had questions about his cost of equity calculation. And so he had a risk-free rate in Vietnamese dong, which was pretty close. Then he had a beta, and we'll talk about betas a little later. And then he got to the equity risk premium, and he said he'd got the equity risk premium by looking at historical data in Vietnam. Let me ask you a question. How many years of historical data do you think you'll have in Vietnam? There was no equity market till this century, right? 2004. In fact, he had 9 years of data. That was all he had. It wasn't for not lack of trying. There was no equity market. So he had computed an equity risk premium of 7.35% based on 9 years of data. I said, before you go any further, I think you might want to compute the standard error in these numbers. It was 11%. When you have an estimate of 7.35% and a standard error of 11%, you're drowning in noise. You have no idea what the equity risk premium is. So you need a lot of history, right? So let's say your only way of estimating equity risk premiums is to look at historical data. And I come to you with a Vietnamese stock. There are two choices you have. One is to ask me to come back in 91 years. So by then I'll have 100 years of data. I'm not coming back. Or you try to do something right now. I'd strongly suggest you go the second route. So I'm going to give you two ways in which you can get equity risk premiums for the rest of the world. Because to be honest, the US is the only market with a long enough and a deep enough history that you can even compute a historical premium. And even there, I don't trust the number. So let's talk about estimating equity risk premiums for other markets. So let's do an intuitive start. Let's assume the equity risk premium for the US at the start of 2024 is 4.60%. And I'll tell you up front, it's not a historical premium. I'll come and back it up. Let's say I feel pretty comfortable with that number, 4.6%. And I ask you about the equity risk premium in Vietnam. Do you think it'll be higher than 4.6% or lower than 4.6%? Is Vietnam a riskier market than the US? Yeah, it's a young, growing economy. This isn't an insult. It is true that if you have a young, growing economy, you have more risk because more things can go wrong. So the equity risk should be high. So you got half the game done, right? It should be higher. The question is how much higher? That's a challenge that I've wrestled with for 30 years. How much higher? And I'll give you my starting point. You're not going to like it. Remember those default spreads we started the class with? From the CDS market or the government bond or the rating? I'm going to start with that. I know it's a measure of risk in the bond market, and I can just add the default spread onto my US premium and say I'm done. If you remember the start of 2024, based on the rating, Brazil's default spread was 3.28%. You can either use, this is where I said be consistent. If you've stayed with the 1.87 at this stage, you'll also do the same equity risk. I'm going to stick with the 3.28% because it gives me a chance to estimate the numbers for almost every country. I take the 3.28% default spread, add it to my 4.6%, which is my US equity risk premium. And I end up with an equity risk premium for Brazil of 7.88%. This is the state of the art in how investment banks, if you can call it that, right? There's not much art. It just sounds like a very simplistic way of doing things. But they take a US equity risk premium that they've estimated, so 5, 6, which they might have made up, and they add the default spread for a country to that equity risk premium to come up with an equity risk premium of the country. Now, do you see why I clean up government bond rates for default spreads? Because if you don't do that, you're going to double count risk. Once by using a high government bond rate, which already includes the risk, and then adding it on again to the US premium to come up with your equity risk premium. So think of this as the most simplistic way to get equity risk premiums in other countries. Get the default spreads, which you needed anyway to get your risk-free rate, and add them onto the US premium. So when I first started, that's the path I took because that's what everybody was taking. And then about 2 years in, I said, but this doesn't make sense. 3.28% is the default spread I would charge if I bought a government bond. I'm not interested in buying a government bond. I want to buy Brazilian equities. So let me again ask you an intuitive question. Are equities riskier than government bonds or safer than government bonds? riskier because they're the last person in line. So I said, the 3.28% can be my starting point, but it shouldn't be my ending point because equities are riskier. So we'll talk about, I'll come back and talk about the middle weight. So basically what I do is I look up two standard deviations. One is the standard deviation of the government bond, that government bond from which I got the 3.29% spread of 18%. The second is the standard deviation in the Bovespa, which is the Brazilian equity index. You want to do an algebra problem? Here's what the algebra problem looks like. I'm sorry, 20% was the standard deviation of the government bond. So if I bought the government bond with a standard deviation of 20%, what am I charging as a spread? 3.28%. Equities are 1.5 times more volatile. So I should be charging 1.5 times the spread. I know it's incredibly simplistic, but basically that means the spread I'm going to use is 4.92%. It's the 3.28% scaled up for the fact that equities are riskier. My equity risk premium for Brazil is going to be 9.52%. So think of this as default spread and default spread plus. They're basically variance. There is the middle page, the previous page, there's actually a third approach. And this was actually developed by Goldman about 30 years ago. Partly in response to my pushing back saying, you guys can't use default spread. So here's what they did. They said, look, we know what the US equity risk premium is. Know is a strong word, but you can estimate it. Here's the way we're going to compute the equity risk premium for another market. We're going to look up two standard deviations, just like I did. But the two standard deviations they looked up were the standard deviation, the Bovespa, and the standard deviation, the S&P 500. Do you see the mild variation here? You take the S&P 500, let's say the standard deviation is 18%. You take the Bovespa, the standard deviation is 30%. They took the US equity risk premium of 4.6% and scaled it up. So no default spread even enters the picture. And the equity risk premium they came up with was 7.67%. When I first saw this, I thought it was pretty neat. So I decided to compute this for every country in the world. And here's the problem I ran into. Almost all of Africa ended up with lower equity risk premiums than the US. Costa Rica ended up with almost no risk premium. Why is that? What drives the volatility of equity indices? In addition to the risk of the country, what drives volatility in equity indices? For prices to change, what has to happen? Somebody has to trade, right? If you have no liquidity in a market, guess what your standard deviation is going to go to? It's going to go to zero. I remember reading a Wall Street Journal article about the Egyptian equity index. And they said there was a guy with a chalkboard in front of the index writing every transaction as it happened. That must be a really liquid market, right? He wouldn't even fill up the chalk. When you have no liquidity, your standard deviation goes towards zero. And with the Goldman approach, I'd be giving Costa Rica a 1% equity risk premium. I was giving the Ivory Coast almost a 0.5% risk premium. If you're investing in the Ivory Coast with a 0.5% equity risk premium, you should have your head examined. But this is part of the reason I'm reluctant to use this approach, because when I try it across countries, it just stops working. I can understand the logic, I can understand the intuition. Okay. You're saying, don't you have the same problem with your approach where you look up the bond and the equity, they come from the same country. So when there's liquidity is low in one, it's also low in the other. It seems to work even in less liquid countries. So empirically, I'm going to stick with the third approach. Start with the default spread, scale it up. I've been doing this now I started doing this in the mid-90s. I did it actually for the class I was teaching that semester, and because I had the Excel spreadsheet, I decided to share it. It's become the most downloaded data set on my website. So some of you might end up in jobs where people use this equity risk premium. If you want, and they think it's mystery. They think I'm some intellectual genius working in a room with all kinds of data. This is like seeing sausage made. So after I strip it down to basics, I said, that's all you do? This is all I do? At the start of 2024, here's how I got the equity risk premium for every country in the world. I started by estimating an equity risk premium for the US of 4.6%. I'll come back and explain how I got that. That was my starting point. For every country, I looked up their rating on Moody's. For 160 countries, those Moody's or S&P, I took one or the other. So basically, I needed a rating. Okay. If the country was rated AAA, let me emphasize that again. If you're rated AAA, can somebody name some AAA rated countries around the world other than the US right now? At least in Moody's, it's still a AAA. Australia, New Zealand, Germany, Netherlands, a lot of the Scandinavian countries. There's one country in Asia that is a AAA, actually a city-state. It's Singapore, right? And Singapore is the only AAA-rated city-state country in Asia. For all of those countries with AAA ratings, guess what the equity risk premium is? 4.6%. And here's my reasoning. If you're all mature markets, you can't have different equity risk premiums. And why is that? Because one mature market has a 4.6% premium and the other has a 7% equity risk premium. What are people going to do? They're going to pull their money out of the 4.6 and put into 7% until they equalize. So all AAA rated countries get the US equity risk premium. If you're not AAA rated, I look up your default spread. I actually look it up at the sovereign CDS. I look it up so you can pick whichever default spread you want. And then what do I have to do? Multiply the default spread by the ratio of two standard deviations, the standard deviation in equities and the standard deviation in a government bond. But to get a standard deviation in a government bond, remember what I said, you have to have a government bond. And I was finding myself running into a brick wall trying to get that many countries. So I started cheating about 20 years ago, if you can call it that. Instead of trying to get this for each country, I computed it collectively for all emerging markets by looking at two indices, one maintained by S&P, the other, I think, by MSCI. The S&P index is an emerging market equity index. I looked up the standard deviation of that index. And MSCI maintains an ETF of just emerging market government bonds. And I looked up the standard deviation of that index. That ratio on January 1st, 2024 was 1.34. You see, what am I going to do with that? Let's say your country has a 2% default spread based on its rating or whatever. I'm going to multiply the 2% by 1.34. I come up with 2.68%. Then I'm going to take the 2.68%, add it to the 4.6%, and I have an equity risk premium for your country. And I do this for every country. You want to see what the world looked like to me at the start of 2024? This is equity risk premium by country, and I've tried to break them down regionally. There I get all kinds of blowback because I put the country in the wrong region. Eastern Europe in particular doesn't like it that I put them with Russia and Eastern Europe rather than, no, but take it for what it's worth. Right? Let's take Asia. You look across Asia, what country has the lowest equity risk premium? I kind of gave away the answer. It's Singapore with a AAA rating. Are equity risk premiums different across Asia? Of course they're different across Asia. The riskiest country in Asia happens to be Sri Lanka. And for those of you familiar with what's happened in Sri Lanka in the last 2 or 3 years, it lost its functional government. There's a coup. So essentially all kinds of second highest is, I think, Laos with a 19.23%. Now, if you're a company and you tell me you operate in Asia, I'm not going to let you go. I'm going to ask you where exactly, right? If you're putting all your, half from Sri Lanka and half from Laos, I'm going to be very scared about what exactly the risk is. But you can see the equity. Let me be completely clear again. There is no intellectual firepower behind it. It's based on what? A starting US equity risk premium default spread scaled up by this ratio. And as I said, it's the most downloaded and used data set on my website. It gets used in the strangest places. And I don't have any control over it anymore. I remember getting an email from the New Zealand Milk Board. I didn't even know there was a milk board in New Zealand till I get this email saying, we're using your equity risk premiums to set milk prices for New Zealand farmers. Who are you selling the milk to, Zimbabwe? Right? But usually the question is, how do you compute the equity risk? I mean, I take them through exactly the lecture. I've created a YouTube video, said, this is what I do. There's no rocket science here. Yeah. But once in a while, I do get an email that I don't know how to respond to. I remember about 5 years ago, I get an email from a Lebanese business person. He said, I'm a business person. I said, the email starts with, you have destroyed Lebanon. I said, what? What the heck did I do? After Hezbollah and civil war, I'm the guy who destroyed Lebanon. So I keep reading. And it turned out that this was an email from a Lebanese business person who'd sold his business, and the appraiser in valuing the business had used my equity risk premium to come up with a hurdle rate. You're saying, what's wrong with that? Now you look across, Lebanon doesn't look that good. It's never looked good for the last decade, not because of my, so basically his point was, you gave this equity risk premium, pushed up the hurdle rate, pushed down my value, you ripped me off. And I said, look, it's not my fault. You can see when you get a high equity risk premium in this table, what's causing it? Is it because I don't like Lebanon? I actually like Lebanon a lot. I haven't been there very much. I've been once to Beirut, but that's pretty much it. It's got nothing to do with whether I like the country or not. What's driving the equity risk? Well, I start with your rating. And if your rating is in the toilet, guess what? You're going there with it. I said, it's not my fault. It's Moody's fault. You want to take it up with them, go ahead, because all I'm doing is carrying it through. So that's basically what's driving the difference. And until about 5 years ago, there are about 25 countries which don't have ratings. They're called frontier markets. You're saying why? I'll name some of the countries and you'll see why. North Korea does not have a rating. Can you imagine going to work at Moody's? You're excited, first day in the job. Your managing director calls you and says, look, I think we should give you a lot of responsibility. We'll give you a country we'd like you to rate. First day. So where am I going? North Korea. We'll drop you off on the border. You walk across the border. There are no direct flights. We'd like you to collect information on how the economy is doing. Would you stay on that job? My guess is you're quitting, right? You can see why these are frontier markets, right? Syria, Afghanistan. And for the longest time, I did not estimate equity risk premiums for those markets. Until I get an email from, I get a lot of my stuff in emails, obviously, from a Syrian business person, must be the last business person left in Syria. He says, I run a business in Syria. I need hurdle rates for my projects. I'm looking for an equity risk premium for Syria on your website, and I can't find it. Why? Very accusatory why. And I told him, look, Syria does not have a rating, and if it doesn't have a rating, I can't come up with an equity risk premium. He said, well, what am I supposed to do in the meantime? I said, get out of the country would have been my reaction, but that wouldn't have been polite. But I said, you have a point. You know, even Syrian business people need hurdle rates. I'm going to try to come up with a way. So starting about 7 years ago, I decided I had to estimate equity risk premium for frontier markets. They're all up there. And here's how I do it. There's a service in Europe called political risk services that attach a numerical country risk score to countries. So higher scores go with with safer countries. So the safest country in the world, according to PRS last year, I think was either Sweden or Switzerland. The riskiest country you can take odds on it when it be Sudan, South Sudan, So they have a numerical score. So I took Syria and I found its PRS score. I think, where is it? There you go, 45. And then I found other countries with similar PRS scores. You can see where I'm going next, right? I found 5 other countries with scores between 45 and 50. 3 had ratings, and it estimated an equity risk premium. Finish the thought for me. I took the average of the 3, I attached it to Syria. You say, that is so simplistic. Guilty as charged. If you can come up with a better way of estimating equity risk premiums for North Korea, I'd love to hear it. And then I'd love to put it into practice. You go ahead and estimate it for me, and I'll use it from that day on. But at this point, wherever you go in the world, I should be able to estimate an equity risk premium. So I'm going to lay the foundations for why this is going to show up in your company valuation. When you think about how equity risk premiums show up in your company valuation, the first is to do what most analysts do right now, which I think is horrifically bad. They take every company in a country and give it the equity risk premium for the country. So if you're a US company, you get the US equity risk premium. If you're a Chinese company, you get the Chinese equity risk premium. If you're a Vietnamese company, you get the Vietnamese equity risk premium. It's based on your country of incorporation. Horrifically bad practice. Because if you're a German company that gets 90% of your revenues in Afghanistan, should I worry about it? Yes, I should. The fact that you're incorporated in Frankfurt makes little difference. The second approach is to bring your, the country risk premium in and scale it to your beta. If you're a high beta company, you're more exposed to country risk as well. And the third approach, I'm going to estimate an exposure you have to just country risk with what I'm going to call a lambda. I'm going to tell you why I gave a Greek alphabet to it. It's not a noble reason, but I did it anyway. So you got to decide what you're going to do. Okay? So here's what I'm going to set up as my way of thinking about equity risk premiums. You can go with the country of incorporation. It's easy. Every country and every company in a country, but it's never made sense to me. I remember when I was doing a valuation seminar, the first time I thought about this seriously is I had to do a valuation seminar in Brazil in the early part of the century. And I was flying to Brazil. It was a long flight. I was sitting next to this really big person who was oozing into my seat. I couldn't sleep. So I decided to check the slides that I have for the next day. And there were two companies I was valuing. And those of you from Brazil probably recognize. One was a company called Embev, which produces beer, and at that time got almost all of its revenues from Brazil. The other was a company called Embraer. If any of you have taken short haul flights in the US, you've probably seen, you probably took an Embraer jet. And the reason, they're both Brazilian companies, but Embev gets 100% of its revenues in Brazil, and Embraer gets about 3% of its revenues in Brazil. So I said, this isn't fair. They're both Brazilian companies, but they can't be both equally exposed to Brazilian country risk. So that's when I started thinking about, I need to weight equity risk premiums by your operations. Now we can debate how to measure operations. One can be revenues, the other can be where do you produce stuff, or some mix of the two. But I'm going to argue, and this is going to be my, this is an argument I've made in other parts of the world as well. When you compute equity risk premium for a company, your equity risk premium should reflect where you do business. So for Coca-Cola, your headquarters might be in Atlanta, but 60% of your revenues come from outside the US, much of it from emerging markets. I'm going to argue your equity risk premium should reflect that. So I'll take a simple example first of how this plays out, and then we'll talk about multiple, if we're in multiple countries. When I did Embraer in 2003, they got 3% of the revenues in Brazil and 97% of the revenues in the US and Europe, primarily in almost mature markets, all AAA rated countries. So when I computed an equity risk premium for the 3% in Brazil, I gave them the Brazilian equity risk premium, which was sky high then, 12.89%. For the 97%, I gave a mature market equity risk premium. And I value Indian companies like Infosys. It's an outsourcing company. Infosys gets about 7% of its revenues in India, 93% primarily from US companies and large European companies. Its equity risk premium looks more like a US company than an Indian company. Now, if you're in multiple countries, and this is Embev in 2011, at which point it already jumped across countries, it's 64% of its revenues is still in Brazil, but you can see the remaining revenues are broken down. The rest of Latin America, and it has a significant Canadian operation. My equity risk premium for Embev is, first, two questions. One, why do you think I'm using revenues as my measure of operating exposure? You want to try? Why do you think I use revenues? First is desperation drives you to it because it's the only item I've seen companies systematically break down geographically. Some of them do give me EBITDA by region. I wouldn't trust those numbers further than I can throw them. Because here's what I keep saying. Ireland seems to be a very profitable part of the world for you. Maybe it's truly profitable. Maybe the taxes are driving that. Revenues are the one number you really can't mess with much. And second, revenues can never be negative, and that's a big plus. Why? Because when I do weights, if I have a negative number, what the heck do I do with it? I can't sell short a country when I do my weighted averages. So I use revenues as my weights, partly because, I find it available for most companies. Now, if you take a company like Coca-Cola, they don't break revenues down by country. Why? That'll be 72 lines long, right? So what they do is break it down by region. If you go back to the page I showed you on equity risk premiums, you'll notice that every region has an equity risk premium. You know how I compute this equity risk premium? It's a weighted average of the equity risk premiums of all of the countries in that region. Weighted by what? By GDP. So the Asian equity risk premium is going to have a really heavy weight on China, followed by India, and then you're going to see a big drop off in the rest. So that's why I compute the regional averages, because the companies like Coca-Cola, that's what you're going to get is those regional numbers, and they give you the revenue breakdown. As you look at your company, don't let your frustration get in the way of actually doing this, because companies are horrifically bad about breaking their revenues geographically. US companies among the worst. typical US company revenue breakdown is going to be, we get 72% of our revenues from the US, 28% from the rest of the world. Come on, guys. The rest of the world is a really big place. Can you start to get a little more specific? Okay. But don't sit there and say, what do I do with the rest of the world? That's all you have. Attach a global equity risk premium to the rest of the world, move on. Okay. So the focus on revenues is just simplistic, but it's practical, but it can sometimes get you into trouble. If I focus just on revenues, Embraer's equity risk premium is very similar to US equity risk premium. But here's the problem. Embraer's factories are all still in Brazil. So if Brazil goes to hell in a handbasket, will Embraer be affected? Absolutely. So clearly, where you make stuff also matters. In some companies, that might be the only thing that matters. So I'll leave you today with my last example of an equity risk premium. Let's say you are looking at an oil company. What do oil companies do? They extract oil from the ground, they sell it into a global oil market. I don't care where your revenues come from if you're an oil company. Every oil company, I care about where you get your oil. If you get your oil from Nigeria and Kazakhstan, for whatever reason, God puts oil in the riskiest parts of the world, or if you get oil, it becomes the riskiest part of the world. I don't know which leads what. The truth is, oil companies are like emerging markets in terms of risk, and oil companies do break their production down by region. This is the Royal Dutch, oil and gas production by region, my equity risk premium. And this was in 2016 for Royal Dutch, reflects where you get it. So if you've picked a company, that's why I keep pushing you to pick a company. I would encourage you to look for this information in the footnotes. It will be in the footnotes and geographic breakdown. Take what you can get. Use my equity risk premiums. I'm okay with it, and do a weighted average for your company. I will see you on Wednesday.
So I was looking at the weekly challenges and I can't access it.